Hello everyone. Today we'll discuss about some of the myths with relate to NAV. In my previous session, I've explained you what NAV is in terms of mutual fund, that is net asset value. Today we'll discuss some of the myth and misconception people have regarding this NAV. So before that, let's first review that and discuss how does NAV of a scheme changes. Now, some major factors which play a role in the NAV, and I'm sure you must have seen my previous video where we have discussed that what NAV is. NAV is nothing, it is a net asset over number of units. And what is a net asset? Net asset is the market value of investment less expenses. So if I look at that formula and then try to think that what are the things which may hamper the NAV, the first thing and the most important thing is the market price of the securities, the market value of investments, the market value of the assets where the fund manager has invested, which can be equity, debt, gold, commodities, anything. And as and how the market value of those security will change, the portfolio value will change. So that's the first thing, how the NAV will be impacted. The second aspect, which is a more critical in case of debt funds and bond, where if some write-offs happen, that is, a fund manager might have invested in some bonds and the value of those bonds have become zero, right? The companies have got bankrupt, and therefore when you do mark to mark valuation of those bonds, there has been downgrading of those bonds, and those bonds have been written off, and all the assets, if the company has invested in those bonds which is as a investment, those need to be written off, and therefore the value of that asset will fall down in that same manner, and that's the reason why the NAV will definitely fall. Third, which is just a mathematical calculation, is the ex-dividend date. Now, what is ex-dividend date? There are schemes, and we'll discuss in detail in subsequent slide, that which will offer you two options: the growth option and dividend option. So in the dividend option, what actually happens, as soon as the market value of the portfolio goes up, the fund manager distributes certain amount of thing as a cash dividend to the investor. Now, but obvious, as soon as the cash dividend is declared, the market value of that asset will fall down, and therefore the dividend, as soon as the dividend is declared, the NAV will fall down. So these are some of the prime reason why the NAV will change. And now let's look at what are the misconception and myth which are prevailing around this. So one of the most common myth, and many customers get befooled in this, is that there are two schemes. One scheme has a lower NAV, other scheme has a higher NAV, and the lower NAV is a better NAV, better scheme. Now, this logic doesn't work in case of mutual fund. This can work in the normal share market where the prices of those shares are determined by demand and supply. Here, the price of the unit is not determined by demand and supply. Rather, whatever number of units as investor requires, those number of units are created. So there is no restriction on the supplier side of the unit creation. In the share market, it is. Every day the shares are not created. It is between demand and supply, the share price are fluctuating, and therefore there this logic can work that the share at present is underpriced or undervalued. In case of mutual fund, this logic, it never will work. Now, for example, like there you can have two schemes. One scheme having an NAV of rupees 10, the other scheme having an NAV of rupees 1000. Now, assuming they largely have the same portfolio. So, if the portfolio value goes up by 10%, the NAV of this scheme which has 10 rupees will go by 11, whereas the NAV of which has 1000 rupees, it will go by 1100. Therefore, your valuation of the amount of wealth which you have will remain the same, irrespective whether you have invested in a scheme having NAV of 1000 or having NAV of rupees 10. So the NAV price is immaterial in making decision whether the scheme is good or bad. So this is the first misconception people have, and many scrupulous advisors, they start giving this advice. Okay, this is a new scheme having a lesser NAV, you will get higher number of units, and therefore this is a better scheme, and rather than not allowing investor to invest in some a matured scheme where the NAV is high. So this is the first misconception, that the NAV price per se has nothing to do with the valuation, with the decision whether the fund is good or bad. So this is very important thing which is there. Another very important thing which is linked to this part, which is called whether I should always invest in NFO. Why? Because if I invest in NFO, I will get at a price of rupees 10, and I will get more number of units because the price is less. Again, the same logic. It is not necessary that the price rupees 10 is a good price, and the current scheme which is running scheme which has an NAV of 500 is a bad scheme. Rather, my personal observation is one should avoid NFO unless and until it provides a very high degree of novelty. Something new is coming up, which is not existing in the market. And these kind of the innovation which the fund managers is coming up is not there in the market. It's only for it's only for limited time that the scheme is open, and therefore you want to adventure and innovate, and you want to invest in the scheme. Otherwise, making investing in NFO in the same category of scheme which you already are invested doesn't make a sense. Even though your distributor will push for NFO at times, that I'll call that distributors bad distributors or bad advisors who will pushing investors to invest for NFO because NFO yields them higher commission. So it is therefore advisable not to invest in NFO unless and until it brings a very good novelty and a very innovative scheme objective, which is open only for limited time. So when you're looking at the fund, it is not the price which matters. What matters is the fund manager's expertise. One should look at the past performance of fund which the fund manager has managed, what kind of fees he's charging, what portfolio where the money will be investing. That are the factors one should look upon while choosing upon which fund should I choose, and not the price of the scheme which is reflected in the NAV. Third thing which at times people do ask, well, there's a scheme which continuously pays a dividend, and therefore I get some amount of money in my bank account, therefore this scheme is a good scheme, and the scheme which is not paying dividend is not a good scheme. Again, this is a very bad misconception here. Now, as I mentioned before also, all schemes, most of the schemes offer two choices to the investor. You have a growth option and you have a dividend option. Initially, you need to have dividend reinvestment. Now, SEBI has abolished that. There are two options which are left, which is growth and dividend. And the same scheme. So, how does it work? So, but obvious, if you choose a dividend option, what happens there? If you choose a dividend option, as soon as there is some capital appreciation in the portfolio, that capital appreciation is shared by the fund manager or by the AMC to the investor. Which means what? As we discussed before, as soon as the capital appreciation is shared in the form of a dividend, in form of cash dividend to the investor, the market value of the portfolio or the numerator in the NAV falls down, and the NAV falls down. Whereas if I'm choosing a growth option, there is no dividends are declared, and the market value of the portfolio, if it's increasing year on year, day by day, the NAV will keep rising. And therefore it depends upon who is the investor and what is his need. So somebody who's looking for a regular income, who keeps on looking for regular income, and is dependent on dividend income or regular income from the mutual fund, it is only to those it is advised that they should go for dividend option. Somebody who's looking for a long-term wealth creation, uh, and want to accumulate money for long-term wealth, then the dividend option should never be opted. One should always ideally look for a growth option in the scheme, and it's the same scheme managed by same fund manager, all having the same portfolio. And therefore, the overall compounding impact and overall growth impact will be visible much more in the growth option than the dividend option, because dividend options, you will keep on getting dividend, but you will not have a growth in your NAV. Whereas in the growth option, there is no cash dividend declared, but the NAVs of this scheme will keep on going up. Therefore, this myth that dividend paying funds or schemes are better is again a very bad misconception. So I hope this might have made clear that what are the various misconceptions people have while investing in mutual fund, and must have given much more clarity about what NAV is all about. Thank you very much.